Have you always wanted to know what a cap rate is or commercial property? In this video, I've grouped together the chapters 5 through 9 in my free mini-series. In the next 10 minutes, you will learn market value versus market price, principal reduction that occurs when a tenant is paying down your mortgage, true profit versus cash flow, what is a cap rate, and a deeper dive into commercial properties and if they make good investments. Let's get right into it. Hi everyone, we spoke last week about appreciation. Now, how does real estate appreciate? How do you know what your real estate is truly worth? The answer lies in something, more definitions. We're going to be unpacking market value versus market price, two very different but important definitions. So market value is the price at which a particular house in its current condition will sell within 30 to 90 days, approximately, or what an appraiser or an appraisal might suggest the market value is. Market price, in comparison, is the actual price that something sold or historically what someone is willing to pay for it because they actually paid that money for it. So to recap, market value is the estimated value, market price is the actual price which a rental property has sold for. So which one do you use? Well, in theory, you might want to use both. You might want to know how much the property is worth during refinancing, so you need to know the market value. Or you might need to liquidate your assets and pull your money out completely, so market price is more important. In the context of appreciation, well, appreciation, if you recall, is the value that real estate increases year after year. Therefore, if you're wanting to know the value of your portfolio and the profit you have made, i.e. your equity, you have an appraiser go out and put a value to the property. And that'll do it. So we've discussed what your property is worth and how it appreciates. The next thing we're going to cover is principal reduction and what that means for your equity. In this segment, we're going to be learning about principal reduction. So what do we mean? If you're investing in property and leveraging your money, you have a mortgage on the property. If you own a home, you know that you pay a mortgage every month. In your monthly payment, a portion of that mortgage goes to the interest, or rather it goes to the bank as a payment for loaning you that money. The other portion of your monthly payment goes to pay down the principal of your mortgage or the balance. It's definition time. Principal is the original balance of the loan money excluding interest, or the remaining balance of a loan excluding interest. Therefore, you purchased a rental property for $300,000, you put a 25% down payment, so $75,000. So you minus those two and your principal balance is $225,000. Principal reduction means that each month that $225,000 is getting paid down little by little. So yes, at the beginning of the mortgage, more of your monthly payment is going towards interest and only a small amount towards principal. But who's paying this mortgage amount? It's not you. You guessed it, it's the tenant. So let's take another example. $225,000 principal at 4.5%. If you plug these numbers into any online mortgage calculator, again, you can find them on Google, you'll see that the average principal reduction over 1 year is $5,000. In year 10, that number jumps to about $7,000. So what does this mean? With everything being equal, if you rent out one property, the principal balance is paid down by your tenant by $5,000 to $7,000 per year, or $70,000 over 10 years. To summarize, what have we learned in the past few segments? Well, we've got equity, appreciation, market value, principal reduction. In the next segment, we're going to be putting all of this together and compare these concepts to cash flow. We'll see you next week. Welcome. In this week's segment, we're putting all of those concepts together over the last few episodes. We're going to be explaining cash flow versus true profit. Now, true profit isn't a real term per se, but it's a concept that I like to use when I'm advising our investors. In a very early episode, I explained cash flow and talked about that $150 to $200 of cash flow in a single family home. Well, 12 times 200 is $2,400. And honestly, for $2,400 a year, why even bother? So why do it? Well, let's add up some of the other benefits that we mentioned. You've got equity, principal pay down, appreciation, or rather the equity is the appreciation of the current market value minus what you owe on that mortgage. So how do we add up equity? You've got your principal pay down. So for example, on that $300,000 property with the $225,000 mortgage, you've got $7,000 in principal pay down. On that same property, if you take 7%, now you're talking about a $21,000 appreciation in the market value. So let's add up everything. We've got $2,400 of cash flow, $7,000 of principal paydown, and $21,000 of property appreciation. The total of that is $30,000 versus $2,400 of cash flow. Now you might say, but I don't see the $31,000 in my pocket. It's not real. But your bank might disagree. If your property increased by 31 grand a year, you can refinance that property and pull out a portion of that money. The market might disagree as well, because if you wanted to, you could pull out the entire $31,000 by just selling it. But the true power of owning real estate, the $31,000 is only for 1 year. Okay, so that's $60,000 in year 2, $90,000 in year 3. When's the last time you could make $90,000 in 3 years by simply owning a property? So what have we learned? Well, hopefully you agree with me that you shouldn't be only looking at cash flow as that prime decision, whether you're going to buy the property or the success of the property. Really what you want to look at is that true profit, which is going to give you long-term wealth. In our next segment, we're going to be discussing what type of income property is right for you. Stay tuned. So, you're committed. You want to buy a rental property, but how do you know what is good or a bad investment? Regardless whether you choose to invest in commercial properties, single-family homes, condos, or apartment blocks, each of these properties should be evaluated for their performance. So we're going to talk about a universal term most real estate investors use to calculate their rate of return, which is the cap rate. Now, cap rate or capitalization rate is used in the world of commercial real estate to indicate the rate of return that is expected to be generated on a real estate investment property. It's computed by taking the net income the property is expected to generate and dividing this by the property asset value or the market value, and it's expressed as a percentage. For example, if you purchase an apartment block that generates $70,000 in net income per year, and it's worth $1 million, well, you take $70,000 divided by 1 million equals 7%. Side note here, any debt servicing, like mortgage payments, is not to be included in this calculation. It's only the net income of the property. So if you have a mortgage or other kinds of payments towards debt, you would take those out of the net income before performing the calculation. While the cap rate can be useful for quickly comparing the relative value of similar real estate investments in the market, it should not be used as the sole indicator of an investment's strength because it doesn't take into account leverage, the time value of money, and any future cash flows from property improvements. So you might be asking, what is a good cap rate? Well, the internet gives generalities, but doesn't seem to want to commit to a number. Most good cap rates are between 4 and 10%. The most important thing, use the cap rate to compare assets within the same asset class. For example, you wouldn't take an apartment block cap rate of 6% and think it's better than a 4% cap rate on a single family home because they're completely different assets. And side note number 2, because cap rates use net income in their calculation, they're not really supposed to be used to evaluate things like flips, land, vacant property, even vacation rentals or short-term properties. Vacant land or properties is obvious. There is no net income to use in the formula. And short-term rentals and vacation rentals skew the numbers a little bit because they're normally calculated, on a day or weekly basis, while cap rates are based on annual income. For the next series of segments, I'm going to be discussing the different types of rental properties, and we'll be starting with commercial properties. Thanks for watching. In this episode, we're going to be discussing commercial rental properties. Let's dive right in. So, commercial properties. Well, what are we talking about here? Commercial real estate, or CRE, is property that is used exclusively for business-related purposes or providing a workspace rather than a living space. Living space, on the other hand, would constitute residential real estate. Most often, commercial real estate is leased to tenants conducting income-generating activities. Examples of this: storefronts, retail strip malls, large shopping centers, warehouse space, office space, even multifamily apartment blocks is considered CRE. Now, some in the industry might consider that, but for the purposes of this video series, I'm going to treat apartment blocks in its own category, but more on that later. So, what's different about commercial real estate? Leases. Commercial leases will typically run from 1 year to 10 years or more, with office and retail space typically averaging between 5 and 10-year leases. This is contrasted to the shorter-term month-to-month or year leases in residential housing. Another interesting factor, the size or square footage of the property is proportional to the length of the lease, meaning the larger the property, typically the longer the lease. So what are the advantages of commercial real estate? Well, we have predictable cap rates, longer term leases, it's easier to evict tenants, attractive leasing rates, sometimes get impressive returns, and of course you have the potential for capital appreciation. So on the flip side, what are the disadvantages of commercial real estate? Well, the rules and regulations are different. The leases are complicated and can vary from property to property. There's many extra charges to understand, such as CAM charges, property taxes, charges to tenants, net leases, and then you have cost. It takes a lot more money to invest in CRE, and not to say it's impossible, but you have to have deeper pockets or partners. And that'll do it for this segment. Join us next time when we're going to discuss vacation and short-term rentals. Thanks for watching. If you want to know more about how to own a rental property and manage it yourself, I'm releasing 2 to 3 new videos per week. Subscribe to the channel and get notified when they are posted, and also help grow the channel so YouTube will put this information in front of other people like yourself. And if you're interested in checking out a community of like-minded investors that have come together to share ideas and experiences about being a landlord, check out my Rent It Yourself community. Link is in the description below. Thanks for watching.